Welcome. Today, we are looking at foreign exchange and the balance of payments. This is a key topic in your commerce exams for SS3. Pay close attention. Let us begin. First, let me explain the meaning of foreign exchange. Foreign exchange refers to foreign currencies. It also refers to the market where currencies are bought and sold. Foreign exchange is needed for international trade. When a Nigerian company imports goods from Japan, it needs Japanese yen to pay the supplier. The company cannot pay with naira. It must buy yen. The price of one currency, in terms of another, is the exchange rate. For example, if $1 equals 1,500 naira, that is the exchange rate. Foreign exchange is traded in the foreign exchange market. This market has no physical location. It is a global network of banks, brokers, and other financial institutions. The market operates 24 hours a day. It is the largest financial market in the world. Now, let me explain the exchange rate. The exchange rate is the price of one currency in terms of another. Exchange rates can be fixed or floating. A fixed exchange rate is set by the government. The central bank buys and sells its currency to maintain the rate. A floating exchange rate is determined by demand and supply. If demand for a currency increases, its price rises. If demand decreases, its price falls. Most major currencies have floating exchange rates. Some countries fix their rates to the US dollar or the euro. Nigeria has a managed float. The Central Bank of Nigeria intervenes to influence the rate. The exchange rate is important because it affects trade. If the naira is weak, Nigerian exports become cheaper. Foreigners buy more Nigerian goods. If the naira is strong, imports become cheaper. Nigerians buy more foreign goods. Now let me explain the demand and supply of foreign exchange. The demand for foreign exchange comes from people who need to pay in foreign currency. Importers demand foreign exchange to pay for goods. Investors demand foreign exchange to invest abroad. Tourists demand foreign exchange to spend in other countries. The government demands foreign exchange to pay for imports and foreign debt. The supply of foreign exchange comes from people who receive foreign currency. Exporters supply foreign exchange when they convert their earnings into naira. Foreign investors supply foreign exchange when they invest in Nigeria. Foreign tourists supply foreign exchange when they spend in Nigeria. The government supplies foreign exchange when it receives foreign aid or loans. The exchange rate adjusts to balance demand and supply. If demand exceeds supply, the price of foreign currency rises. If supply exceeds demand, the price falls. Now let me explain the balance of payments. The balance of payments is a record of all economic transactions between a country and the rest of the world over a period of time. It is usually 1 year. The balance of payments has three main components: the current account, the capital account, and the financial account. The current account records trade in goods and services. It also records income from investments and transfers like foreign aid and remittances. The current account has two parts. The visible trade account records trade in physical goods. Exports are credits. Imports are debits. The invisible trade account records trade in services. This includes tourism, banking, insurance, and transportation. The current account balance is the difference between credits and debits. If credits exceed debits, there is a current account surplus. If debits exceed credits, there is a current account deficit. The capital account records transfers of capital. This includes debt forgiveness, migration of capital, and transfers of ownership of fixed assets. The financial account records investment flows. This includes foreign direct investment, portfolio investment, and changes in reserves. Foreign direct investment is when a company builds a factory or buys a company in another country. Portfolio investment is when investors buy shares or bonds. Changes in reserves are changes in the central bank's holdings of foreign currency. The balance of payments must balance. Every transaction has a credit and a debit. The sum of all accounts is zero. However, there is often a statistical discrepancy. This is the difference between recorded transactions and actual transactions. Now, let me explain the importance of the balance of payments. The balance of payments is important for several reasons. First, it shows the country's economic health. A persistent current account deficit may indicate problems. Second, it affects the exchange rate. A current account deficit puts downward pressure on the currency. Third, it affects foreign reserves. A deficit drains reserves. A surplus builds reserves. Fourth, it affects government policy. The government may take action to reduce a deficit. It may devalue the currency. It may impose tariffs or quotas. It may encourage exports. Fifth, it affects international confidence. A large deficit may make foreign investors nervous. They may withdraw their money. This can cause a currency crisis. Sixth, it affects borrowing. Countries with large deficits may need to borrow from the IMF or other countries. Now, let me explain the causes of a balance of payments deficit. There are several causes. First, high imports. If a country imports more than it exports, the current account will be in deficit. This is the most common cause. Second, high oil prices. Oil importing countries suffer when oil prices rise. Third, weak exports. If a country's exports are not competitive, they will not sell. Fourth, strong currency. A strong currency makes exports expensive and imports cheap. This worsens the deficit. Fifth, high inflation. If a country's prices are rising faster than other countries, its exports become less competitive. Sixth, low productivity. If workers produce less per hour, costs are higher. Exports suffer. Seventh, capital flight. If investors take their money out of the country, the financial account will be in deficit. Eighth, high debt repayments. If a country owes a lot of foreign debt, it must send money abroad. Now, let me explain the consequences of a balance of payments deficit. A deficit has several consequences. First, depletion of foreign reserves. The central bank must use its reserves to pay for the deficit. If reserves run out, the country cannot pay for imports. Second, currency depreciation. A deficit puts downward pressure on the currency. The naira falls in value. Third, inflation. A weaker currency makes imports more expensive. This pushes up prices. Fourth, higher interest rates. The central bank may raise interest rates to attract foreign capital. This slows economic growth. Fifth, reduced economic growth. High interest rates and inflation hurt the economy. Sixth, international pressure. The IMF may require the country to implement austerity measures. Seventh, loss of confidence. Foreign investors may flee. This worsens the situation. Now let me explain how to correct a balance of payments deficit. There are several policies. Expenditure switching policies aim to switch spending from imports to domestic goods. Devaluation is an expenditure switching policy. Devaluation makes exports cheaper and imports more expensive. This reduces the deficit. Tariffs and quotas are also expenditure switching. They make imports more expensive or limit their quantity. Expenditure reducing policies aim to reduce total spending. Austerity measures reduce government spending. Higher taxes reduce disposable income. Higher interest rates reduce borrowing. These policies slow the economy. Imports fall. Supply-side policies aim to make exports more competitive. These include improving productivity, reducing regulation, and investing in infrastructure. Borrowing from abroad can finance the deficit temporarily. However, this increases debt. Exchange controls limit the amount of foreign exchange that can be bought. This is a short-term measure. It often leads to black markets. A common exam question asks you to define foreign exchange and explain the exchange rate. Here is a sample answer. Foreign exchange refers to foreign currencies. The exchange rate is the price of one currency in terms of another. Exchange rates can be fixed or floating. A fixed rate is set by the government. A floating rate is determined by demand and supply. The exchange rate affects trade. A weak currency helps exports. A strong currency helps imports. Another exam question asks you to explain the balance of payments and its components. Here is your answer. The balance of payments is a record of all economic transactions between a country and the rest of the world. Its components are the current account, capital account, and financial account. The current account records trade in goods and services, income, and transfers. The capital account records transfers of capital. The financial account records investment flows. The balance of payments must balance. A current account deficit is often a cause for concern. Another exam question asks you to discuss the causes and consequences of a balance of payments deficit. Here is your answer. The causes of a deficit include high imports, weak exports, strong currency, high inflation, low productivity, capital flight, and high debt repayments. The consequences include depletion of foreign reserves, currency depreciation, inflation, higher interest rates, reduced economic growth, international pressure, and loss of confidence. Countries try to correct deficits through devaluation, austerity, supply-side policies, borrowing, or exchange controls. Let me give you a quick summary. Foreign exchange is foreign currencies. The exchange rate is the price of one currency in terms of another. The balance of payments records all international transactions. It has three components: current account, capital account, and financial account. A current account deficit is a common problem. Causes include high imports and weak exports. Consequences include currency depreciation and inflation. Policies to correct deficits include devaluation, austerity, and supply-side measures. Keep reviewing. Keep practicing. See you in the next topic.